Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in. Welcome to Swimming with Allocators. This episode, we have Benedikt Langer. If you are following the interaction of emerging managers and LPs at all, you have heard of Benedikt, or at least his publication, Embracing Emergence. Today, we are going to hear from Benedikt the journey he went on working with a family office who realized they wanted to work through great managers rather than looking for direct deals, as well as what he has planned for the Embracing Emergence community and how it could be helpful to you. Welcome, Benedikt.
Thank you so much for having me on. I'm really excited.
Absolutely. You have a very unique background that you also have trained to be a pastor. How does faith and finance and family office investing, how do you end up on this path?
I think the best way I can start explaining that is one of the GPs that we have back, Daniel Kimmerling with Descience. He once said this great quote on a podcast. He said, "The best investors are 50% manager, 50% consultant, 50% rabbi." And I think that math actually ends up adding up. I think the truth is that a lot of times venture, it is a very personal journey. It can be a journey that is really difficult and very hard, almost nearly impossible. And I think I really desire to walk deeply with people and to, number one, be a person that people enjoy traveling with, and also at the same time be a person that can be helpful while other people are traveling. And at the end of the day, and I know a lot of people say this, backing GPs is a people business. And I think LPs need to be really good at seeing people for who they really are. And that's also it's just based on reps. It's a craft, and I haven't mastered it yet, but being a pastor definitely added a lot of reps to that craft. Because we all deal with the false self, and the false self is I tell myself and tell you guys something that I am, but deep down I might not be. And I think being able to look through that and telling who's this GP really on the surface and also deep down, and being able to back that with full confidence and having a really firm understanding of who is this person, what drives them, maybe even what are their insecurities, how were they brought up, what are their values, what are their ideologies, all those things. They build this mosaic of us being able to back a person with high conviction. So being a pastor somehow just fits into the puzzle piece of at least of what I think I am good at as an LP.
It's a peculiar group. So we know where you are today, and talk about great publications. Everybody should be on your newsletter as well.
Oh, thank you.
But when you're starting from scratch, talk to us about that story.
Yeah.
How do you even build frameworks? Where do you start? How do you learn? Tell us about that journey.
I got to join the family office a year after the Liquidity event that kicked off that journey for the family. And during that time, typically it's a lot of chaos. It's a lot of things that aren't formed yet. At the same time, you have a new type of pressure to deploy. So we had several different strategies that we're pursuing, but because the family had the largest leasing and financing company in the tech sector that was independently owned, technology was something they were very comfortable with, and we had some initial network. So venture was something that we were very interested in and wanted to pursue. The first thing that we pursued was direct investing. We did deals. They're decent. They're not venture worthy though, to be honest. And we learned that luckily very quickly that was not what we were good at. And we eventually, even once we dug into the deep networks, because we're a family office in Dallas. We're not cool enough to meet Travis before he starts Uber in a hot tub and play Wii Sports with him. That's just the reality. And we got kicked out of a lot of rounds, even once we started to get to the best founders. because they get to pick the cap table, and we're a family office. You don't really need us on your cap table unless we're highly, highly strategic. And even then, maybe yes, maybe no. But we had backed an emerging manager who had backed a founder that we wanted to invest in at a later round, and he got exposure at a much cheaper pricing and way earlier. And for us, accessing that emerging manager was easy. Accessing the founder was super difficult. And venture is an access game. You also need to be good at picking, but that skill goes out the door if you just pick bad, if you only have access to bad deals. So that was really then what we started to focus on and learn. We're like, okay, a probability of accessing the best GPs versus accessing the best founders is incredibly different. We have a much better probability being an LP to do that. We also started to learn a little bit more about the return profile of emerging managers. And not that you should go into venture with this mindset, but we did look at what is the worst case scenario here. And worst case scenario with a portfolio of startups, being a family office, they can all go to zero. However, portfolio of a bunch of emerging managers, that portfolio going to zero is very low. This is not why you should go into venture. Venture, you should go for top quartile, top decile returns. But at least it got us comfortable with being an LP because we were able to somewhat pitch to the family the risk return profile and the outlook, and at the same time our ability to access these types of people. And then we also simultaneously spend a lot of time figuring out what are we actually good at, because we went from operating to investing. Those are two very, very different things. And in the meantime, we started another company because we just first generation, second generation, built the initial family business, sold it. You can't get that out of the system.
Once you realized you wanted to sort of build your own internal fund of funds, what was the strategy to select those managers?
So we came up with a thesis that we are now applying to everything we do in the family office, is we invest in people who invest in people. So the family's business was operated for 35 years. The retention rate was something I've never heard about. The son I work with, he's a pastor. I'm a pastor. The story of the family is being able to back people and give people an opportunity that maybe wouldn't have one. I mean, I shouldn't be doing what I'm doing based on my background. But they gave me a shot at it. And it makes me run a lot harder just because I'm aware of that. So to be honest, that's the strategy. Find really exceptional people who are insanely gifted at backing people. Like, people are the most predictable pathway. People are the most predictable pathways to success for us because we get that. So backing GPs who know how to back founders, that's really important to us. The way we typically get it, some of those insights are just unique questions. I think being a pastor, we've learned what questions to ask to get to the core. I think Peter Thiel talks about asking questions to reveal value in hidden places. And that's, I think, what we're pretty good at. One question we always like to ask is, what do you look for in the founders that you invest in? Oftentimes things like humility or grit, things like that come up. But then we ask, well, how do you define humility and how do you know the founder has it? And then 90% of GPs don't have a good answer to that. And that just tells us that maybe they haven't thought about these things often enough. So that often leads us to no.
I love that. I mean, when I first got exposed to your writing, I was enthralled with how you were articulating, in my opinion, perfectly the nuance of the role of being a fund manager in venture. So in so many other careers, and even in venture, a lot of people try to separate, hey, it's professional. This is what my grit looks like, professional. This is what my track record looks like, professional. But I saw quickly in your framework this blending of humanness and professionalism, right? Could you talk about that and how that, your investment philosophy is steeped in that?
So, Emergence, this is why I call it the newsletter and the platform this way. Emergence is the phenomenon that the sum of the parts is bigger than the parts are by themselves. So, I think for emerging managers, the really, really good ones, when their professional side and their human side come together, 1 + 1 is 10, and they're not separate. Like your career can have looked a certain way, your angel track record can have looked a certain way. You may have come from a firm that has looked a certain way, but if that does not match your ability to foster relationships, your thoughtfulness, your creativity, your emotional decision-making pattern, those types of things, then you might still be good, but you probably are not going to be top decile. We really think those two sides, they multiply each other. So that's the whole concept of emergence, and we really believe in that. And we just need to look at that holistically at the end of the day.
You've described a very qualitative process initially looking at the emerging manager landscape. I'll let you describe it, but this is a process that you're ranking people through PitchBook data, etc.
Yeah.
Have you moved? Is that almost like the first qualifying round, and then you're going to some of these more qualitative
Yeah.
observations, or has your process actually shifted where now this is much more you're relying on recommendations from other GPs and other LPs, etc., for sourcing?
Yeah. I think data and intuition are a tension. They're not always a balance. Like when people say balance, it often communicates harmony. I actually think data and intuition just like they're opposites, and you kind of have to always go back and forth between them. That's how you end up in balance. So when we initially started, there was not a whole lot of intuition because we didn't have a whole lot of reps yet. So we went through PitchBook. We exported every single fund and startup that was listed on PitchBook at that point, and we formulated our own framework in terms of follow-on investment, who were on their cap table, or what startups did they invest in, and how did their valuations go. And then we reached out to a humongous list of the top startups in funds that were on those lists. And being an LP, to be honest, that's very easy, because if you tell people you're an LP, they most likely want to talk to you. And some of those calls ended up in investments from us. And at the same time, I probably spent 8 to 10 hours a day on Zoom for a year, a little bit more than a year. We just knew we needed to get repetitions in this. Mm-hmm. And you don't want to learn with other people's money. So we just really spent time learning. And we always say we went through a time where we wanted to do wine tasting, but first we needed to taste water, coffee, and wine to figure out what was wine. And then you can start tasting all the wines next to each other. And we didn't even know what wine was. So the process you're talking about, just getting some more insights on data and who's actually good, that really helped us do that. At this point, those rankings, they're so outdated and not really representative, but they were a good direction, at least to start out at, so we wouldn't waste too much of our time. At this point, I think the network that we've built really helps us find the best GPs. We've invested in one this year who we've known for 3 years, and this is our first LP check to him. So we really, at this point, thrive off of the relationships we've built over time. At the same time, we try to stay actively out there. We don't want to just rely on past relationships because funds are constantly forming. But embracing emergence helps us to find those GPs before they ever come out raising. So it's a combo.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have our stellar partner and industry expert, Shane Gowdy. He's the leader of Sidley's venture funds practice. And if you get value from this podcast, we have Shane and the Sidley team to thank for it. They make these recordings possible. we are looking forward to hearing from you, Shane. Liquidity has been a huge topic the past few years. And could you share an example of something you've or your team has done with the GP of late to walk us through what is finding one of these, maybe it's a secondary vehicle or opportunity fund. What does it actually look like?
I'll get to a more specific example in a minute, but just an observation kind of globally about the just activity level and just the insight and the level of discussion we're having with fund managers about getting liquidity. Now, having a more robust M&A and IPO market certainly helps, but it doesn't solve all the relative problems of the world. So I think what we've seen is a lot of fund managers establish much closer ties to the secondary fund community. Just even if it's just a diligence, a relationship establishment, just basic blocking and tackling of being a good venture manager and creating channels for liquidity. Just managing basic paths like that, even regardless of a more specific transactional structure. There's just been a lot of dialogue between the secondary world and venture capital, whether it's company side or whether it's venture fund side. People are having active discussions, and those have led to strategic acquisitions of certain strips of companies, kind of onesie twosies, exiting of positions on some things. The secondary players tend to like a bigger portfolio. They don't really look at particular sector assets unless it's AI, and then they'll buy into one asset and hope roll the dice on the crap table and hope to God that particular company is really going to make it and break it, and it has succeeded for a number of them. And obviously a lot of the big issues are the valuations that come with these transactions and what kind of real liquidity are you providing for your LPs. The more exotic things that are happening, are things like continuation funds. Those are really only happening at the very largest venture shops. A lot of that has to deal with just the fact that you may have to become a registered advisor and not be an exempt reporting advisor anymore. And there's some real costs and consequences to exploring those channels. But one real interesting transaction that I worked on, obviously client will remain nameless, is we established a level of preferred equity in a fund within an existing fund structure where we somewhat reopened the fund for a new or two new third-party investors to inject some capital into the fund based on a particular third-party valuation of the portfolio. We made a distribution of some of those proceeds to the underlying, what were now common limited partner holders, to gain them some liquidity. And then on a go-forward basis, some of that capital would then almost reopen the investment period to be able to invest in new companies. A lot of conflicts, a lot of really funny issues, a lot of structuring, a lot of conversations to be had to do something that exotic. But those are the kinds of things that we were looking at, this time last year to really try to massage and manage a way out and gain the kind of, again, gas in the tank that these venture capitalists need to be able to, from a track record performance standpoint, to create good relations with your LPs, but create your numbers. We're looking at MOICs and TVPI and IRRs, and, we got to have, we got to put points on the board. And so, as you get launched into kind of these days when maybe it's the apples are a little more bent towards the ground and easier to pick, nonetheless, there's still some picking to do. And, those are the kinds of things that we were doing over the last couple of years to really try to create liquidity for our clients.
Yeah. I can think of at least one fund who they just reopened their earlier fund for additional investors recently. And it was interesting to look at the way they were positioning and messaging it. They said, we know what's in here and we know it's really good. So, if you're one of the LPs joining now, you have so much more information.
Yeah, and on the reverse side of that, you'll see, in particular, again, with the entree of this AI effect on everything, it's really starting to explore more robustly things like opportunity/annex funds, right? More when we've run out of the capital that we can spend on these great companies, it's not necessarily even to think, on the secondary front, it's almost doubling up on the companies that we do have. Mm-hmm. And so seeing that kind of extra injection of capital, because we saw a million different SPVs of all shapes and colors in particular on big AI deals and, 9-figure SPVs being formed. It was nuts over the last like year and a half, the kinds of things and the sizes of the deals. And that's only continuing to proliferate. So, whether people try to be a little more collective and pool that capital for more of a blind pool vehicle as opposed to onesies and twosies for these great deals of theirs that get negotiated to death. And but nonetheless, it's been a very interesting to see a sea to swim in for a long time and see all the wonderful sea creatures that pop up as we swim through it. It's good stuff.
Man, I would love to understand. You just said these SPVs are getting negotiated to death. How many layers of people there are to negotiate with?
Yeah, it's a lot, right? And in particular, when you get the very large institutional investors, and then it's almost like negotiating a main fund. It's the levels of economics that they've got to pay. This management fee or that carry, or are we tiering carry based on the performance of the company? And let's pair with that. Yes, we're forming an SPV, but we want even co-investment on the SPV. And a lot of it is just prescient in relationship management for the underlying fund managers. And it's kind of our job to handhold them through that. Here are the advantages and disadvantages of agreeing to maybe not the best economic term, but from a relationship management, as you're thinking about forming next blind pool vehicle, and illustrating for the limited partner community about the access to the deals that you have and the willingness that you are to hear their voices in what they want. It's not just the capital, but it really is the purpose behind it. And, a lot of that really is just, working with people to kind of see the forest through the trees a lot of the times. And yeah, but it's been crazy. I mean, there's been deals where it's had preferred, you get private equity concept, net IRR return hurdles, and all kinds of stuff discussed. It's been a hell of an 18 months, no doubt. It's been wonderful for me as, I represent all different investors in the venture stream, but they're venture investors, right? And we get up to the growth stage, concentrated firms or growth stage deals that start to sprinkle on them a lot of these private equity elements to them. Having colleagues who not only on the fund side, but on the deal side just get it and can really sophisticatedly add a lot of advice and content to the kind of consultation you're doing with your venture clients. These upstream deals get really complex, and having this kind of incredible horsepower here to our firm has been so accretive to our ability to really do these deals well. It's been fun.
And now back to our LP interview.
I want to move to how, an emerging manager can actually start to engage with you and kind of other family offices. But first, to even get into the funnel, I know we've spoke before, and you said that many managers focus too much on building a personal brand rather than a reputation. Can you speak to why that's a mistake?
I wrote about this, and I brought this. The definition of reputation in the Merriam-Webster dictionary is the overall quality or character is seen or judged by people in general. So reputation is about character, and I think that pierces much more deeply than the personal brand. I think we have disguised the personal brand as a shortcut to fundraising, and that might work for some people. And I'm not saying a personal brand is intrinsically wrong, but a personal brand without a reputation, I don't think that's the way to go. A reputation speaks much more deeply about you, and it helps you have other people speak more deeply about you to people behind where you're not even involved in the conversation. And I've talked with Michael Streck. He runs Allocator One, a fund of funds in Europe. They write anchor checks into first-time managers before anybody ever invests. So it's high conviction investing as an LP. And one thing he had mentioned to me, what sets apart the number 1% of GPs is they're commercially minded. They build a firm. They really, truly build a company. And I think building a firm is highly correlated to building a reputation, because you're building something that is bigger than yourself. You're building something that can last. So over the long term, a personal brand will be more fragile than a reputation. And I don't think a personal brand is there's nothing wrong with it, but it's not a shortcut to fundraising.
You're spending so much time meeting with these folks who are at Fund One, Fund Two. Is your intention to find those firm builders and carry through with them, or with your return goals, etc., are you going to stick in a lane of first and second time funds?
I think though where we're best at is finding people at an inflection point. So that does lend itself to Fund One, Fund Two. However, we don't really have a formulated framework, or if, are we going to go to Fund Three, Fund Four? We have done that. It also just depends on where the other strategies of the family are at that time in terms of liquidity and cash flow and those types of things. So sometimes it's a no for other reasons, and sometimes it's a yes for other reasons. So I don't know. There's no recipe that we have to that. It's just in the moment decision.
How do you think about when you're first meeting someone, and maybe they're a solo GP or two-person team and thinking about scaling? Is there anything that you ask them on even just like those transitions to like scaling a team?
We haven't asked those questions, but somehow it's always worked out. For example, one fund we've backed is 1517, who backed college dropouts. They ran the Teal Foundation. Whenever we think about those types of funds, we always think about the firm name first before we think about the GPs. So maybe that's just one association that helps us with that intuition. And then another one I brought up, for example, Dan, he managed to grow his team. And what we've always heard from him before he started hiring a lot of people was his deep care for taking care of people's families when they worked for him. So, and that is more so real even now than it was back then.
Yeah.
So he always felt very responsible for his firm being able to provide for the people that work for him. And that does speak to somebody's intent of hiring and staying there for a long time. And Daniel is somebody who he'll leave it all out on the field.
Yeah.
And I mean, these funds are the GP's baby.
Yeah.
So, and some people care more about it than others. That's just the truth. And I think you'll be able to find that out pretty quickly if you talk to enough.
I have to bring up something just because of your backgrounds, Benedikt,
Yeah.
and my background. My dad's a pastor, obviously,
Yeah.
but the naming thing, I know you've written about why names are important, but it made me think, I've always thought it was weird when pastors name their churches after them.
Oh yeah.
And last name. And I feel the exact same way about venture firms, right? Like it's just like there's something there. And so
Yes.
do you want this to be a living legacy that lives
Yeah.
after you, or is it just about you?
Yes, I want 100%. It took me 3 months to name Embracing Emergence. And my wife was so annoyed at some point because she was like, "This is just a newsletter. Just name it whatever." But I wanted it to really communicate my convictions, what I'm about, what I want to do, and bringing people together. So, and that's the case for every business. The name of your company needs to communicate upfront what you do, why you do, and what value you bring. And why should that be different for a venture firm? And I think a lot of venture funds don't do a great job at including their name in what they do. So J.R. Tolkien, he wrote The Lord of the Rings, which is arguably one of the greatest trilogies in the English language of all time. And when you read the books, you really enter his world. He gives people names, places names. He developed language for the elves. You start breathing the air of that world because of the linguistic consistency he developed.
Yeah. For you, embracing emergence,
Yeah.
I saw you just sort of redid the website and things. What's next for it? What's the vision? You started out just naturally writing.
Yeah.
You put a title on it. Now it's sort of
Right.
about building a community. What's the vision now?
So the vision will always be helping LPs underwrite emerging managers better, because that's the problem we have at the moment. That's the biggest inefficiency. And the other biggest inefficiencies help emerging managers actually do good pitches, because transparently, probably 90% of pitches suck. Pitch decks are not very good. Storylines are not very good. But it's not the GP's fault. They often just lack insights. We talk to hundreds of funds a year. So when you do that, a lot of pitches just start looking the same. You need to have some sort of understanding of how you can stand out against the other funds that you're basically competing with for capital. So that's another thing I'm passionate about. But I redid the website a little bit to look more journalistic. I've started interviewing LPs that I've been friends with for a long time, and it's like as if we were chatting, and I just transcribe our conversation, make sure everybody's good with what it looks like, and then I publish it, because I want to give a window into what LPs talk about, as if they're friends, because I am friends with the people that I interview, so that the people reading it, which a lot of them are emerging managers and LPs, can actually have a transparent understanding of, okay, here's what some LPs actually are thinking. And what will come up a lot is, oh yeah, let's call it what it is. We back people, we don't back data. And we back ideologies, and we back values. Those things will come up through these interviews. So I want to be more journalistic in my approach.
We opened this conversation with speaking about how difficult LPs' roles are. And, I don't feel like that's slowing down anytime soon with more funds, more spin outs, lack of liquidity. Could you speak to what you're thinking is going to happen over the next 5-10 years for the LP function?
Yeah, I asked this at an LP the other day. He started backing emerging managers in 2016, and I asked him, would you rather go back to 2016 where there was very few funds but no data, or invest right now with more data but a ton of funds that are constantly raising? He wanted to go back in time. So I don't know. It's hard to predict, but what we're feeling in real time as a family office is our capital is becoming more and more valuable as a family office specifically, because the current environment is restricting a lot of endowments, larger ticket check writers. So our access is going up and up and up year over year at the moment. And I also think, I call it the influence to check size ratio, is also going up. We get to have a louder voice with the same amount of capital. So I think, like, just selfishly, it's a great time to be a family office, and I think it will continue to be a great time to be a family office for the next 5-10 years if we manage our liquidity correctly. So that's partially why we built a cash flowing company. We have cash flowing investment strategies, but we're also then in return fine with our capital being locked up for a long time through venture, because we have other things. Like, we just understand the function of venture is to produce outsized returns over a long period amount of time and not look at what happens for a long time. We read the updates, but man, we're like 4-5 years in with some. Even the returns that are on there now, we don't really talk about it too much.
Are there any of these sort of venture adjacent strategies or products that you have gotten excited about, that you've brought to the team? You've got your kind of fund of funds, emerging managers strategy. Speaking of secondaries, is there any other sort of tech privates play
Yeah.
that you're excited about?
No. Venture is what we're good at, is what we're doing. So
Yeah.
anything that doesn't fit under the family office thesis, we stay away from.
Yeah.
So if it is not about backing people who back people, we don't do it.
Yeah.
Or we outsource it. So because not every investment strategy thrives under that, and the keyword is thrive. Some investment strategies are indifferent to your ability to pick people. Like for some strategies, that shouldn't even matter. So those strategies we either outsource or we don't do. And venture really thrives on that. The business that we have really thrives on that, and what we do in real estate really thrives on that. So that's what we focus on. That's the very short and blunt answer.
So Benedikt, I know you're actively always a person who's reading different things. We've spoken about your love of reading, the classics as well. I got to get you to read some books that were written in the last 20 years.
I bought one. I bought one. Thanks to you.
Good. But I'm curious, what's one lesson you've recently learned from one of those books or somewhere else that's changed how you think about investing?
I was chatting with an LP friend, Nico Mizrahi from Pattern Ventures, and he shared something with me, and that was his instinct he had from a very young age to disarm people and make them feel safe. And I was just reflecting, I might not be doing that early enough. Maybe that's always an intent and do it along the process of a relationship with a GP. But I think doing that on the front end really helps, because sometimes it can be more difficult to create that safe space with a person after a certain amount of time has already passed. So that is something I took away that will affect how I approach people. And then I've been reading a book. It's called Economics as if People Mattered. Small is Beautiful. And it has a section in it. It's called Technology with a Human Face. And we're building a business that is a tech business, but we also obviously invest in a lot of technology. And we have formulated a framework that we actually believe being a human-first business and investor will actually set us apart more than creating more automations and systems. So we built internal systems, for example, for our business, but they're shielded off of our clients. Our client never interacts with our business. Even if we have automations, they go to our team, and then our team has to pass them on to our clients. So that's one example, and that affects the types of GPs that we invest in and their outlook on the future. I read Sam Altman's thing that he recently posted last week. I listened to Peter Thiel talk with Jordan Peterson about progress. He made a really good point. We went from exploring the moon, the late 60s, to going to Woodstock, sorry. Like, we went from exploring outwards to exploring inwards. And I think that inward exploration has its place, but it slowed our progress down immensely. Going outwards means you're a little bit more self-giving. It's a little bit less about you. And I think the best GPs have some of those traits and views on the world and the future. So that's where backing ideologies comes into the game a little bit. Not that we don't want to invest purely based on our values, because that would just assume we're right all the time, which we're not. But understanding the outlook of the GP of the world and the future, I mean, that's what we're backing, right? We're not backing now. We're backing like the next three years, and then how those investments plan out over 10, 12 years. So reading those types of books just gives me something to think about that I couldn't think about myself.
It's been an absolute pleasure giving us all something to think about outside of ourselves. Thanks, Benedikt.
Thank you so much for having me. You guys are lovely to talk to.
Thanks, Benedikt.
See you later, allocator.
After Portfolio Tile, Investing with a Smile.